Good morning and welcome to this Monday, September 20th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, haven't seen this for a while, but we've got futures down significantly this morning. Dow futures currently down 650 points. S&P 500 futures down 75. NASDAQ futures down 258. So we're talking about a pretty steep sell-off across the board to kick off the week. And this is the start of the worst or second worst week of the year. Something I've been writing about, talking about quite a bit recently is the September 20th to September 26th period, which encompasses this entire week. And dating back to 1950, this is the only 7 consecutive day period of the year where the S&P 500 has negative annualized returns every day. Again, this is the only period, the only 7-day consecutive period throughout the year where the S&P 500 has a historical annualized return every day that's negative. And so waking up this morning, I mean, obviously I wasn't thinking we'd wake up to Dow futures down over 600 points, but all last week I was talking about building up cash because what this tells me is just to be careful. And we're seeing, a little bit of an a lot of acceleration from the selling that we've seen really since September began. So September already was off to a rough start, and at least at the open today, it looks like it's going to accelerate. We have the Fed meeting coming up tomorrow and Wednesday, so perhaps the Fed will say something that'll slow selling down. But at least for now, looks like the market, the bears are out there and ruling what's going on here. Hope everybody had a good weekend. It was a nice weekend here in the Charlotte area. Of course, I'm a big football fan, so it's nice to see the Carolina Panthers off to a good start. And my hometown Washington football team, or Redskins if you prefer, off also to a decent start this year. So enjoying the football. Of course, my Virginia Tech Hokies took one on the chin on Saturday. So congrats to any West Virginia fans out there. But anyhow, I enjoyed my weekend. It was a good football weekend, and weather down here in the Charlotte area, pretty nice this time of the year. So all in all, good weekend for me. Hope you all had a good one as well. For those of you who are new to Earnings Beats, I do want to take you all over to earningsbeats.com, where you can see at our homepage, if you scroll down, we have a free newsletter. And I think one of the days last week, I write in so many different areas, I can't remember sometimes what I wrote where. But I think last week I wrote about the upcoming bearish period in the EB Digest. So anyhow, if you are new to us, love to have you join. It is a free, completely free newsletter. No credit card required. You can unsubscribe at any time. Just go over to earningsbeats.com, scroll down, find this little box where you can register. All it takes is a name, email address, hit that subscribe button, and we will get the EB Digest out to you every Monday, Wednesday, and Friday morning. Normally by about 8:30, we try to get it out by, maybe within an hour of the market opening. Mostly it's educational, but there certainly are trading opportunities if you so desire. But we try to teach in this newsletter some of the things that are really important to us, which includes relative strength, earnings related gaps, how to trade those. Those are some of the more common things that we talk about. But I think you'll enjoy it. So make sure you subscribe to EB Digest. We'd love to have you in the community. Also, we reach out to this community quite a bit when we have free events. So that's another reason to be part of this. When we do a free educational event, we will reach out and send room instructions to everybody on this Earnings Beats Digest. So if you haven't already checked it out, we'd love to have you. Moving on to the action from Friday. Dow Jones Industrial Average was down 166 points, S&P down 41, NASDAQ down 138, mid caps down 19 points, small caps actually rose 2 points. So there was your winner from Friday. Small caps did okay. But if you look across the board, look at the beginning of September and how it pretty much marked the top. The Dow was not quite at the top, but close. S&P 500 beginning of the month was at its all-time high. NASDAQ was at its all-time high. Mid caps were threatening. Small caps, well, about a 3-month high. But so far this month, we've seen selling. And like I said, at the top of the show, we're going to see it accelerate here early on in the day. We'll see whether or not we can respond, and maybe cut into some of these losses throughout the day. The AD lines across the board, I still think look pretty good. Dow, we've seen roll over a little bit with the price action. Same goes for the mid caps where we've rolled over with price action. But S&P 500 and NASDAQ, both the AD line, not far from its high. It wouldn't take much to see a big breakout in the AD line on both of those indices. As far as the sectors go, all the groups, all the sectors were down on Friday. We've seen that a lot recently. So there's definitely been a more concerted selling effort that's been taking place. Materials down over 2% on Friday. Technology down more than 1.5%. Same goes for utilities. Communication services down 1.1%. Industrials down over 1%. So, and if you look across the board, you're going to see very similar to what we just looked at on the indices. Beginning of September, since then, we've seen quite a bit of selling across our sectors as well. And this is the only month of the year, September, the only month of the year where stock prices have ended lower more often than they've ended higher. So the month of September, I think it's on the S&P 500 dating back to 1950. I think the S&P has been down 38 times in September and been higher 33 times. But this is the only month that's the case. All the other months we've seen those months go up more than they go down. So we know that this is the month. We know this is the month we got to be careful. It's also the third month of a calendar quarter. March, June, September, and December is not where the hay is made in terms of stock market gains. We generally see weakness in those calendar months, the third calendar month of each quarter. So keep that in your mind, as you're developing your trading strategy. Long-term investors, most likely doesn't matter. You're in it for the long term. You're not trying to time things. I'm talking about traders, those who do like to try to time things. You've got to know the historical background of the stock market here in the U.S. Because I think it plays a role. I think that there's a lot to learn from history. So anyhow, let's keep moving on. 10-year Treasury yield. We got, I think, one economic report out later this morning, and that's the housing market index for September. Expectation there is for 75. August was also 75. So we're not really looking for much there. As I mentioned earlier, the Fed will start its meeting, two-day meeting tomorrow. So Wednesday at 2 p.m. Eastern. You can expect the latest policy statement. I'm not expecting the Fed to do anything, certainly not in terms of rates, but the market will be focused on every word. What are they going to do with tapering? How do they view inflation? Is there any change? They're going to get out their magnifying glass. They're going to look at every word that is said and compare it to the prior month. And if you think about it, the Fed is carefully wording what they're trying to say and what they're trying to translate. They try to be very transparent. So I think it's going to be important, not only the fact that there's not going to be a change in interest rates, but also what do they say? And like I said, everybody will be sitting on pins and needles trying to pick apart their statement. All right, 10-year Treasury yield, you can see, let me just get you a quick update, back down again. Made a move last week, Wednesday through Friday, went from about 126 up to almost 140 we closed at 137, but we got up close to 140 intraday, I think 139. Couldn't make the breakout though, and here we are right back down again. So anytime the 10-year Treasury yield is moving lower, got to be a little careful. I mean, stock market's been going up even though the yield's been going down. But historically, when the yield is going down, what that means, quite literally, is that money is going into treasuries. When the yield is going down, money is going into treasuries, and every dollar that goes into treasuries is a dollar that's not going into the stock market. So typically the stock market's biggest moves occurs when the yield is moving up. So perhaps the Fed will say something where it will trigger some selling in the bond market, and that could coincide with a market advance later this week. But just keep in mind, historically, we don't normally see too many big advances in the stock market during this week. Let's move on to, I want to go through and talk a little bit in talking technically about the S&P 500. And just wanted to look at some of the key levels that maybe we should be thinking about with the stock market. And, as we pull back, where are levels that maybe we might see the stock market reverse? So let's annotate here. The first thing I would say is we broke out right. See this top right here, and then we broke out, and then we went back down and we reestablished a triple bottom right about there. So I think right about 43.75, 43.80, that's going to be the first area. And we may challenge that at the opening bell based on futures. So we're going to have a big gap down. If you're wondering, okay, when is this over? When is the period over? When is it safer to get back in? Well, I can tell you, anytime you've got the 60-minute or hourly PPO below the center line, you're in a downtrend short term. And so you can kind of see what we're doing here, trending below the moving averages, 20 days below the 50-day. When things are healthier, we're going to see the PPO move back above zero line, so back into positive territory. We're going to see price action move back above the moving averages, and we'll get a golden cross with the 20 moving back above the 50. Now, that's not calling the bottom. That's kind of looking back Monday morning quarterbacking and saying, okay, the bottom was in, and now we're starting to move back up again. But that may be what you look for. You may not want to try to call a bottom, especially in September and especially this week. So you may want to wait just to say, okay, let's see what happens here. Does momentum pick back up again? Does the Fed help the market, or does the market keep selling? There are a lot of things to keep in mind this week. But that would be the first level, and we're going to open there probably or close to it at the opening bell this morning, 43.75, 43.80, something like that. Okay. The next level that I would look to, again, I look for prior highs and then the lows after those highs are made. So you got this high right over here, and then we kind of had a little bit of, we got through it, but barely made the move up. And then where'd we come back down to? Right here. So this is going to be the next key area of support, in my opinion. You could draw two lines. You could draw right there to mark the top. You could mark here, the bottom. So right in this range would be the next level. Now, another thing that I look at is I try to visualize these channels. Now, keep in mind, we're on an hourly chart. Hourly chart's breaking down. We might want to step back, look at a daily chart. But one thing that I would be looking at is connecting the highs that we've seen. And that's about, over the last 6 months, these are three highs right here, which also coincided with the high at the end of August, early September. And then sometimes I just take this and I'll drag it down to find some key lows. So that would be one for sure. And that comes in right at that 43.70 level. However, if that 43.75 area, 43.80, right in that zone doesn't hold, you could take this down to here. And oops, get that out of the way for a second. It's not perfect, but somewhere in there. And then we go back up here. So, you've got different levels to consider, but I think that 43.75 area is going to be the first one. And then I think we're looking down here at 42.50-ish to 42.75. This week, even though it's bearish, it's not like I'm calling for a crash. Even a 1% move to the downside this week is generally a pretty big move. So don't think in terms of, it's the second half of September. That means the market's going to drop 20%. That's not what I'm saying at all. Historically, the tendency is for the market to move lower, and you just have to have knowledge of that in your trading. Talked all week last week about building cash coming into this week. So I think that there's a precedence here that we just all need to realize. That's all. All right, so that's the S&P. Those are a couple levels that I would be watching for. I mean, if we got big reversals, that would go a long way, I think, toward marking a bottom. And as I said, let's maybe stretch out to a daily chart and just get maybe a little better sense on the S&P 500. So here, and I'm going to go 2 years. I'm just looking for, a channel to kind of watch. This was pre-pandemic, so that's kind of a pretty important high. And I'm going to connect this time those highs from the pre-pandemic level right here and the recent top. So let's just say, that's a trend line. I mean, I don't know if this is going to connect with anything, and maybe right there. And the only reason I'm drawing it there is you've got multiple levels right in here that connect with that line. So maybe we come back down. If we come back down to this level, you're going to see a pretty significant pop in the VIX, the volatility index. And the VIX can do a really good job for us marking bottom. So if things really pick up and the VIX takes off, and VIX is going to take off today with the market looking like this in pre-market. But just keep in mind where the VIX tends to go to mark secular bull market bottoms. And normally what you're going to see is, I'm going to say 25 to 30. I mean, yes, we've gotten up here into 35, but this is closer. This is more, I always refer to these as the aftershocks. You get up to 85 or 90, and then you start coming down the VIX. You get these aftershocks, which take you up into 30s and 40s. That's an unusual level during a secular bull market. I would say 25 to 30. The VIX hits 30, I'm going to be looking for a bottom in the market. So we'll see. Let's see what happens with the VIX this week. But just wanted to point that out as well. Let's move on to, I wanted to go through some blog highlights. So if you're not familiar, I write a lot, not just to our members at Earnings Beats, but also over at Stock Charts. I've been writing at Stock Charts since 2006 in their Chart Watchers newsletter. Started writing my Trading Places blog. I believe it was in September of 2015 that I started. And I used to write every day in this blog, and I used to try to publish right around 9 a.m. So all you had to do is come over a little after 9 a.m. and you could get the, the latest, what I was writing. I don't write often there anymore because I do, as chief market strategist, I just have too much to do at Earnings Beats. But I do still write occasionally. Maybe I try to get at least once a week, maybe sometimes twice a week I'll write, but I have no idea what time it's going to be. So one thing I just want to point out is you can go down at the bottom of my article or any of the authors that you follow at Stock Charts, and there's a subscribe button. All you have to do is type in your email address, hit that subscribe button. There's no charge, nothing. It just sends you an email anytime an article is published, immediately upon it being published. So I'd highly recommend you doing that, because some of the information that comes out, I think, is pretty timely and is important for you to kind of get sooner rather than later. So here was an article I just wrote about the transportation group, because if there's one thing that bothers me about the market right now, it's the transports. If you know anything about the transports and their relationship with the S&P 500, they tend to go hand in hand. So when you see the S&P 500 going up for the last 4 or 5 months and transports going down for the last 4 or 5 months, that's kind of a big deal because it doesn't happen very often. The correlation on a daily chart right now is not negative, but I went on to point out the weekly correlation. So what the weekly is doing is looking at the last 20 weeks. The default on the correlation is 20 periods. So when you're looking at a daily chart, correlation is going to be over 20 days. When you're looking at a weekly chart, it's going to be over 20 weeks. So think about 20 weeks. That's roughly 5 months. That's roughly what we are seeing here. Transports down, S&P up. So that correlation went as far negative. This is showing over the last 50 years. This is the worst correlation between the S&P 500 and the transports in the last 50 years. We have never seen these two indices more inverse to one another than we're seeing right now. Now, you can see some of the other times where we went into negative territory. We don't even go into negative territory very often. We stay up near 1 most of the time, which makes sense. When I look at a chart and I'm looking at technicals, the ones that make common sense to me are the ones I pay the most attention to. If you've got 2 lines on a chart, you can't understand why they're doing something, I wouldn't probably read a whole lot into it in making financial decisions and putting thousands of dollars to work. I would be looking at something that makes common sense. This is one that makes common sense to me. If transports are doing well, that's a good sign that more goods are being shipped, or that the market believes more goods are going to be shipped. So looking for strength in the economy. Well, as the economy strengthens and more things are happening in the economy, you'd think the S&P 500 would probably produce more revenue and more profits, those companies. So you should see this correlation. The pink line's transports, the other line is the S&P 500. You can kind of see they go hand in hand for the most part. So what does this inverse correlation mean? What is going on here? And I don't have an answer for you, but what I did do is stretch it out to a monthly chart. And on a monthly chart, now we're looking at correlation over 20 months, which is a year and 8 months. We haven't seen inverse correlation but twice. Well, I would say 4 times down to the 0 line. But look at when they occur. 1973, 1977, 2000, 2008. If those dates don't ring a bell, okay, well, the market was in secular bear markets during that time. Okay. So this, when you get into a secular bear market, and I had never really looked at this chart before, I thought it was really interesting. When you're in a secular bear market, if you need somebody to beat you over the head that you're in a secular bear market, I think this chart should do it. When the S&P 500 has been going up and you start seeing the transports going down and it diverges for a period of time and we get a monthly correlation that goes to 0 or below, that should tell you, okay, things are not good. Look at where we are right now. We're up near 1. We're still positive. So yes, the last 4 or 5 months, we're seeing, transports move down, but over the last 20 months, they're going mostly hand in hand. So what this chart does is it just takes that bigger picture look and it gives transports the opportunity to move back on track. And so I wouldn't read too much into the transports yet. You want to be aware of it, but I would be following this chart more. I think probably we're going to see this begin to roll over the next few months and maybe start to move down toward this 0.50 level. I mean, unless things all of a sudden just, transports just take back off again and follow the S&P, the upside, I would expect this is going to roll over. Anyhow, I thought this was a great article and charts, something that honestly I was learning from as I was writing it. But you can go into my blog article or into my blog, Trading Places, and you can scroll down and see, the various charts or articles that I've written and the charts inside. They're talking about options expiration, market maker manipulation. The other thing, or the other blog to check out is Chart Watchers. I try to write in, I do write in here every other week. My partner, John Hopkins, writes in here every other week. So we're always in here once a week. But if you go down to the last article that I wrote, what you need to know about September weakness, talked a little bit about options expiration, but September history. I mean, September 17th to the 30th is weak, but I went on to talk about September 20th to the 26th. So I was giving everyone fair warning about this period. This was out on September 10th. So that's when the article was written. And the worst period in September is from September 20th through September 26th. That's this week. And there you can see since 1950, the annualized return. And you might say, well, yeah, but how's it done during the secular bull market period? Well, there you go, minus 36.46% annualized return. So here we are again. It's, as Yogi Berra would have said, it's deja vu all over again. So clearly, if you want to protect against this time of the year, best thing to do is just be in cash. But anyhow, I just wanted to point out these articles. Make sure, and you, even though it's in the Chart Watchers, you can go down here below and you can subscribe. So anytime I post in the Chart Watchers, you'll get that email to you. All right. Oh, did I break? I think I did break that down. No, I thought I'd broken down daily. The that's 7 consecutive day period, but I didn't. All the returns, by the way, over these 7 days from the 20th through the 26th, they're all double-digit negative annualized returns. Many of them 50-some%, 60%. Some of them might be 25, 30%, but the average is that 36% over the last 9 years. Where is it? Right here. And then since 1950. 1950. 71 years. You can see pretty, minus 38.89% annualized. So don't think, oh, we're going to drop 38%. No, that's not what that means. This is annualized. So you're taking this week and you're just doing the interpolation through 52 weeks. So, if this is 1 week, and you got 52 weeks, I can look at that and tell you that the average loss is less than 1% during this week. So again, it's not a big sell-off, but we do have big sell-offs during this week. And then we'll have other periods where you actually go higher from the 20th to the 26th. So that is just the average. All right, let's keep moving on. I wanted to go over a couple of things here. And I am trying to wrap these shows up before the market opens. So I'm going to just talk a little bit about the earnings that are coming out. We got Lennar coming out later today. Notice the double top right here, right where we topped over here. One of the beauties of technical analysis is where price support and resistance are on the charts. So if you're in Lennar and you're going up to test a key area like this, from a trading perspective, I'd sell. Now, if there are other things, maybe home building stocks are on fire and maybe you believe that the stock's going to break out, maybe you sell half. If it goes through, breaks out, you buy the other half back. If it doesn't, pulls back, you can buy it back cheaper. But the essence of trading, in my view, is taking profits, not trading only when your stocks are going down, but when they go up, take advantage, take the money, move to cash. That creates opportunities to buy other times. So Lennar will be out later today. Tomorrow, just to let you know, Adobe, FedEx, AutoZone, Stitch Fix, they will be reporting Tuesday. Wednesday, you got General Mills, BlackBerry, KB Homes. Thursday is a big day. Nike, Accenture, Costco, Darden Restaurants, Trip.com, TCOM. All of those will be reporting on Thursday. So while earnings season definitely is slowing down, you still do have a couple companies to be checking out. All right. I'm going to take a look at the 3 you must see. So we're going to do the 3 charts here. One thing I wanted to point out, and again, this is more from a trading perspective, but you might look up here and say, well, here are the 2 tops. We never made it that far. Look at the volume on this gap down. So when you move back up into a gap resistance area and you see a gap down on this kind of volume with further selling, when you get back up just to the bottom of the gap, you need to be thinking about profits if you're trading a stock like VeriSign. So it looked like it was good back above the moving averages, but you got to a key area where sellers were in charge 2 months ago. And look what happened. Sellers now back in charge. Another one, Qualcomm, very similar kind of a chart, wanted to point out, except here, when we got up to 150, we were all the way, he had to go back months to find the level, but look at the volume that's where the selling kicked in from 150. We get up to just over 150, roll back over. Qualcomm looks like it's heading lower from here. And lastly, USX. I'm not a big fan of these steel stocks. There you can see hitting resistance, couldn't get through. I think we're heading back down to support down around 2075, 21. So that's what I would look for here. All right, market opening here in about 5 seconds. Want to wish everybody a great day. I'll be back over at Stock Charts TV at 9 a.m. tomorrow, 9 a.m. Eastern. So check that out. All you do, go to Stock Charts and make sure you click on that right around 9 o'clock and get started. Everybody have a great day and be careful this week. Happy trading.